Good morning, Mahantesh. What do you think is the sentiment amongst the retail investors at this point of time? In March, we've seen a huge inflow in the mutual fund schemes because of tax saving purposes. Do you think they remain bullish about the markets? Do you think fund flows will continue, or are some of them turning cautious now?
Good morning. I think the retail investors have been pretty well rewarded in the last 1 odd year, either through their own direct investments because the markets are up, or indirectly through the mutual fund investments that they have made. So the sentiment is very positive, and therefore we continue to believe that that sentiment will strengthen further, and we will see more inflows coming into the markets via the retail investor, either into the mutual funds or directly into the market.
Do you think most of the flows will be through the mutual fund method or through direct equity? Because some of these SIP flows are very sticky. Do you think more will flow through the mutual fund route?
I think the mutual fund route will gain more prominence because what you have just mentioned about the stickiness of SIPs, and frankly it's quite underpenetrated in terms of mutual fund investments. Financial investments per se in household savings is very minuscule, it's in fractions. So the mutual funds will continue to see strong inflows over the period of time. There could also be a possibility of consolidation of some of the mutual funds with the industry players itself as we move forward, and that would mean that the offerings from a mutual fund, the basket of offerings from mutual fund will become consolidated, and you will see more stronger inflows. Direct investments will also continue to happen in the market, and as we go later into the years, I think with alternate investment opportunities being very limited, equities will continue to attract inflows.
Right. Do you think when retail investors make inquiries, they're more interested in the mid-cap and the small-cap based funds or those kind of stocks, given the returns that they've got from the mid-cap space over the last 1 year?
Yes, they indeed would like to invest more in the mid-cap to small-cap kind of funds because they have given more returns, like you have mentioned. And from a retail investor's perspective, in mid-caps have always been the favorites, unlike the large caps. There is a lot of churn also that we see in mid-cap stocks happening from retail investors, and they continue to look at such stocks. And over a period of last 4-5 years, there have been quality mid-cap names that have come to the surface either because of their better business performances and track record, or via some recent IPOs as well. So we think mid-caps to small caps will continue to attract the retail investors' interest.
Right. What about earnings? Do you think some of the mid-cap companies are going to come out with earnings that are going to impress? Could it be better than the larger ones, large-cap stocks? What are the market expecting? Do you think those that have taken the risk to invest in mid-caps will be rewarded from here on, looking at the earnings?
No, it's a relative basis because sector to sector the performances are different. So if you look at the BFSI space, for example, the banking sector will continue to do well, and the mid-cap banks so the large cap banks will continue to do well. The mid-cap banks to the smaller NBFCs are likely to report relatively lower performances. So, but if you take another sector on the other hand, like let's say a cement sector, then the large cap cement companies will not do really well, but some of the mid cap cement companies will do well. If you look at auto ancillaries versus auto OEMs, then it's perhaps and some of the ancillaries which will do well relative to the OEM. So you pick a sector, the performance from mid caps can vary compared to their larger peers, the larger cap stocks. So there is no particular trend that is noticeable in this earnings outlook. You have to take sector by sector.
Right. But on an overall basis, what kind of earnings are the markets expecting? Earnings season hasn't gotten off to a great start, but what are the markets looking at?
So, you rightly mentioned that the earnings have not been too great. They have not started off really well, and in terms of the outlook as well, I don't think the markets players are expecting any great earnings growth for Q4. So the Q4 earnings growth could be well somewhere around 11% plus or minus 2 percentage points in terms of year-on-year PAT growth numbers. And that's not too large, but as you go ahead, and that is view for the next full year FY18, then perhaps the earnings outlook is somewhere plus 17% plus or minus 2-3 percentage points. So between Q4 earnings growth that we are likely to see versus what is expected in FY18 does look better. The market will be forward-looking as they always have been, but this time around it will be the markets will assign greater valuation multiples for the forward earnings than in the past, and we think that over a period of time the Q4 earnings will get ignored, and people will focus more on the upcoming earnings, and therefore the market trajectory seems to be on the positive trend hereinafter.
Right, but don't you think that the markets are ignoring some of the the risk from around the globe, and do you think valuations are at risk because of a correction? Excuse me. You said markets are going to be looking ahead, and they remain optimistic. But could these factors play a spoil sport?
Okay, there were, if you ask me the same question, let's say 6 months back, there were greater amount of risk, global risks that one used to factor in the market. So there was a Fed rate hike event, there was ECB QE outlook, there were geopolitical tensions, there was the US presidential elections, including our own elections here in India. So of all these factors, I think most of these risks have either been relegated to the past, or their incurrence and their impact thereof seems to be now very limited. The only global risk that markets are right now factoring in is the geopolitical risk. You could have eruptions of tensions anywhere in the world, and that could lead to risks, investors taking risk off the table. But as it stands now, the focus seems to be more on earnings, less on the risks, and in an interest rate environment that we have currently, which is very low, the risks, the magnitude of risks also remain very small. So for us at this stage, between the market outlook versus the risk reward ratio seems to be favorable.
Right, but given the risk from the globe that you have pointed out, do you think investors will be taking a better bet or a safer bet with some of the stocks that are more inwards or domestic growth related versus the export related stocks?
Yes, you are right. So that is what we have been observing as a trend, and it's back to the basics kind of inward-looking stock research that most of the investors are tending to do. So the inward-looking sectors such as the capital goods sector or the infrastructure sector, which is an inward-looking, which is India-centric kind of sector, are the ones which are getting greater investor interest. The BFSI space is largely inward-looking, and therefore the growth surrounding whatever happens in the global markets doesn't really affect the BFSI sector, barring the interest rate differentials that exist, and so on and so forth. So the investor interest is getting India-centric now than it was so in the past.
Right. You mentioned about the BFSI sector and the impact being less as far as global disruption is concerned. But if you look at any of these BFSI names, names like Yes Bank, names like ICICI, maybe even IndusInd, Axis, they are largely FII owned. So would they get that selling pressure coming in, because they are really the so-called FII stocks right now?
Yes, you are indeed right. Okay, so when a geopolitical risk arises, and there is a risk off the table, some of these stocks, which are heavily FII owned kind of stocks, face the pressure or face the brunt of that phenomenon. and we do see the stocks correcting quite sharply. But there is enough buying interest even among domestic players for such quality names as the banks that you named, including a Yes Bank, including an IndusInd Bank, or even an HDFC Bank. So these quality banks, irrespective of the FII pressure that one may see when global tensions erupt, will be backed up by large-scale domestic buying, and therefore we don't see the downside pressure coming on too much for some of these stocks.
Right, but as far as banks are concerned, will they continue to grow the way they have been? At least the retail side, 15-20% growth on a year-on-year basis. Is that possible even now at this base?
I think it is because the bank's retail business is largely concentrated around the housing business, housing loans. It is therefore we see there is a huge amount of growth there. With the government's push in terms of housing for all by 2022 and the current subsidy rollout by the government, we think that's one sector which will continue to do well, and therefore retail loans growth can continue to be in that 15% plus growth rate trajectory. And mind you, interest rates are softer at this juncture, so it helps push the retail loans faster relative to, let's say, the corporate loans. So having said that, you asked me a larger question about will banks continue to do really well. We think yes, they will do well. There is a big amount of credit growth that we foresee in the years ahead, coming off a low base in terms of credit growth. So sharper credit growth, expansion of NIMs, NPA resolutions, increased capitalizations. These are positive events that are upcoming for the banking sector as a whole. And you pick your bank, the banks that you are comfortable with, and I think most of them will turn out to be eventually great stocks to own.
You pointed out about asset resolution. Now that's been spoken about for the last 2 to 3 years, that what has to be done regarding asset resolution, and nothing concrete has come at this point of time. Still you expect that there will be that one leg of pain that a lot of banks may have to take to entirely wipe out all the asset quality issues?
I think, Pankaj, we should look at what is happening in the larger environment for banks. Most of their NPAs were stuck in large sectors which were not really doing well. So take telecom, take cement, take infrastructure, or take steel, for example. These were the sectors or the exposures to which most of the banks were facing NPA problems. But over a period of time, what we are seeing is that these NPAs are getting resolved in the natural way. There is consolidation happening in various industries. There is, take steel for example. The sector is doing really well. It's showing up, throwing up good cash flows now. The business is reviving. Telecom, we have seen a mega merger being announced, and if you look at any of the other sectors, cement, there has been a consolidation that is going on, and so on and so forth. So in this process, we are seeing that NPAs and the larger NPAs are getting resolved in the natural way. Of course, it doesn't mean that the cyclical, some sectors are facing cyclical pressure, and therefore there will be addition to the overall NPA block. While we don't disagree with that trend, we think that the larger NPA issues are getting resolved through the natural process itself of businesses recovering via consolidations and so on and so forth. At the same time, as the economy starts recovering, as exports start growing well, as infrastructure thrust begins to come into the economy and so on and so forth, we think banks will have a better chance of resolving the NPAs in due course of time. Apart from the solutions that are being described, being debated in terms of a bad bank, in terms of creating certain SDR, simpler SDR norms and so on and so forth. So we think while that will continue to happen, the natural resolution of NPAs is something that is happening and will continue to happen.
Right. Natural resolution of NPA, you mean that the entire book would grow in line with what GDP is doing and NPAs would remain where they are? So on a percentage basis, it would do well. Also, you will see some recoveries?
Yes, what I'm essentially referring to is the process of recovery or the process where NPA is becoming standard assets by virtue of the business itself doing really well. So we are seeing that process happening.
Right. What do you do with consumer durable names? You think that initial numbers that have come from Titan in terms of their outlook, the overall auto sales that you've got, all of that point out that consumer has not been hit, or the impact of demonetization is now totally behind?
Yes, so let me refer to the last part of your question. The demonetization effect is totally out of the system right now when we look forward. So whatever has happened now in the past, and the consumer sentiment remains quite strong even now. And we have had last year when we looked at the consumer discretionary segments, then we were looking at 7th pay commission payouts and strong monsoons or good monsoons actually adding to consumption demand growth. While there was a temporary blip because of the demonetization that saw these consumer sentiments being affected, right now the impact of the 7th pay commission, the impact of the past monsoon is still playing out and will continue to play out according to us as we go forward.
So most of these consumer durable names, despite recent run-up, are looking good?
I would think so, and of course it assumes that the upcoming monsoon will also be decent enough. If not a normal monsoon, it will be decent enough.
What are your top mid-cap picks right now?
So some of the picks that we would really look at is in the auto ancillary space. So right now we would look at such stocks as maybe Gabriel, for example, that can do really well in the auto ancillary space, or we can look at.
I'll just come back to you. We've just had some technical issues, so I'll just come back. But what Mahantesh was pointing out towards was auto ancillary, and Gabriel India was one of the top picks over there. Of course, it's a name which has not done very well, so maybe it's up 32% in the last 1 year, and they see more upside. So that was one of the other names. Meanwhile, as we resolve that technical issue, let's just look at some of the mid-cap names as well. So Natco has right now gone up. It's up 7% right now, 973, about 7.5% higher for Natco. So that's a name which is doing very well. Gujarat State Petronet is up close to about 3.5 to 4%. That's also a name which is doing well. Since morning, actually, it has done pretty well. REC, PFC, both these power finance businesses are doing very, very well at this point of time, and Petronet is also doing well. Okay, Mahantesh is back with us. Mahantesh, could you just again start with your top mid-cap picks?
So, like I mentioned, we are looking at some of the names in the auto ancillary space. So Gabriel is something that I've named already. We are also looking at Sundaram Fastener as one of our mid-cap picks right now in terms of auto ancillary space. On the consumer side, consumer durable segments, we have talked in the past about the AC stocks, the air conditioning manufacturing stocks. So we had talked about how one of our picks is Lloyd Engineering, for example. Among our recent picks that we had looked at was a logistic company called Tiger Logistics. It's only a BSE listed stock right now. So these are some of those mid-cap to small-cap names that we are currently looking at.
Right. So there were some interesting picks in the mid-cap space. What are the large-cap names that you would like to do?
I think we continue to bet on 2 or 3 sectors in the large caps. So one is the BFSI space, the banking space per se. I've already highlighted that we like IndusInd Bank as one of our picks there in the banking space. The other sector that we like is the automobile space per se. We would single out a Bajaj Auto out there as one of our picks in the autos. To some extent, even a Maruti can do really well. The third sector that we are looking at is the IT space, and we have already talked of how we like Infosys as well. While the Infosys results were muted and the guidance was none too great, but we believe that there is a potential upgrade in guidance coming from Infosys as we go later into the year. Plus, the dividend payout is going to look very attractive as we as we go into the year. So between the dividend payout, the guidance growth that they have already outlined, and a possible upgrade, Infosys appears to be headed towards a plus 12 to plus 16% kind of return over the year, including the dividend return of possibly 4.5%. So that makes it attractive as well.
Right. So let's talk about two names in this. One is Bajaj Auto and one is Infosys. Both of these are contra buys. Let's start with Bajaj Auto. What is the call over there?
So in Bajaj Auto, we like the story in terms of its both exports as well as the India leg. In the India side leg, they have recently launched products like the V, the Domina, which are really doing well. And we think that here in onwards, they will steadily start raising their market share as we go forward. So there is market share growth that is upcoming for Bajaj Auto in the domestic motorcycle segment. We think that the exports will start recovering for them. They have had a downward spiral in exports, something like last 18-20 months. Exports have been steadily sort of degrowing virtually every month. We think that the base is now low enough for growth to resume as we go forward, and barring the recent pressure on the rupee, so they being largely an export-oriented company, and appreciating rupee doesn't really help them. But we think that once rupee starts stabilizing, Bajaj Auto will start growing better and better, and therefore that's one stock that we would pick.
Right. In terms of Infosys, do you also see that even if it was not to do well right now, or they don't upgrade their guidance in the near term, the downside is quite limited?
Yes, I think the downside is limited. If you look at the FY19 earnings, the EPS could be somewhere around 70-72 rupees, and therefore the stock appears to be trading just at 13 multiples right now, which is very cheap, even from its own historical past 5-7 year performance in terms of valuations. And we're not talking of stock price alone. If you look at the valuation, then it is touching its low in a 7-year kind of low valuation band. That makes it very attractive. So low valuation, decent guidance, large dividend yield, and possible upgrade in terms of its guidance makes it very attractive.
Right. Mahantesh, just a word on Indiabulls Real Estate, or any real estate company which comes with a commercial leasing business which has a good yield. You think markets will reward it because it will eventually reduce its debt going ahead?
I think in the real estate and on the commercial leasing side, we would wait the upcoming REITs, issuances by real estate companies. That's the better way to really hold real estate companies, much safer. Unless you do thorough research on retail real estate company, we generally don't want to advise any real estate stocks for our investors. But there are stocks that we look at. It's not that we shut our eyes to real estate companies. Depending on the strength of the company, the upcoming projects, and the momentum thereof, there are good real estate companies as well available to look at. So one of the stocks that we are currently looking at is an Aryan Superstructure, for example, and that's a real estate company. So we need to thoroughly research real estate companies, and commercial leasing is better. Better exposure to commercial leasing can be better taken through a REIT kind of instrument than really a real estate company itself.
Mahantesh, thank you so much for taking out time for us. Always good to get a perspective from you.